Hey guys, what's up? It's Ryan. Welcome back to the channel. Now today we're going to be talking about the stock market and a couple factors that you should be keeping an eye on that may be indicating a potential economic collapse. All right, now before we get into all that, we need to do a little bit of homework and do a little bit of the history of the market. Now, typically a market cycle lasts anywhere from 7 to 8 years historically. Now, what that means is that 1 out of every 7 or 8 years is considered a down year. Now, looking back over the last 3 collapses or market pullbacks, we look at 2008, 2000, and going all the way back to 1986 and 87 before that. Now, guys, I don't have to tell you that these obviously are not typical market cycles, right? They're not 7 or 8 years before every collapse or every downturn, and it doesn't mean that every 7 or 8 years there is going to be a collapse or a downturn. So, with that being said, let's talk about a couple of the things that are happening right now that you should be aware of that may be spelling economic collapse in the future for the domestic market. All right, so first let's talk about household or consumer debt. This is debt held by regular everyday people like you and me. Now, first and foremost, we need to talk about the student debt. Student debt has more than doubled since 2008. Auto debt is at its highest it's ever been in the 20 years that we've been monitoring it, and currently over 7 million Americans are in default on their auto loans. Guys, that's alarming. Guys, 71 million Americans have debt that is in collections right now. That's a staggering figure. 71 million people have debt that has been referred to a collection service or they have defaulted on it. Guys, what that means is that any slowdown in income or rise in interest rates would make it even harder for these 71 million Americans to meet their debt obligations. Okay, now let's talk about corporate debt or debt that companies carry. Guys, leverage lending to corporations is up 40% since 2016. That's only 3 short years and it's up 40%. Now, what leverage lending means is it's lending to corporations who are already in debt. That means corporations that already have debt on their books are borrowing more. Guys, this creates what we call systemic risk. Guys, these loans are poorly underwritten, have minimal protections built in to lower cost, and are being packaged up and sold to consumers as quality debt. This seems a lot like what happened in 2008, and it's very scary. Okay, guys, let's talk about domestic manufacturing. Now, guys, domestic manufacturing is currently in recession. I know it might not seem like that because the economy is quote unquote doing great. GDP is very, very strong right now, and the market is also strong. But US manufacturing is in true recession, meaning that it is in 2 consecutive quarters of negative growth, not shrinking growth, negative growth. In addition to that, manufacturing wages are below the national average. Guys, the US-China trade war is dramatically hurting our commodity sales. And with the United Kingdom determined to make Brexit a reality, this could all further complicate the domestic economic situation. The 10-year Treasury inflation protected securities, or TIPS, have fallen from 1.15% to 0.24%, the lowest we've seen since 2016. Now, a lot of people consider the 10-year TIP a real yield indicator. What this means is that it's the actual purchasing power consumers can expect to see from government bonds after adjusting for inflation. Now, after you've heard all this, you might be panicking, but it's not a good time to panic. Now is a great time to look over your portfolio, make sure that your risk level is exactly where it needs to be. You're not reaching for more yield and taking on more risk than you need to. Guys, Warren Buffett said it best. Be fearful when others are greedy and be greedy when others are fearful. Right now, it looks like a lot of people are being greedy out there. So, time to take a hard look at your portfolio. What I mean by this is if you're at a later stage in life or your working career or you're nearing retirement, you shouldn't have an exponential amount of risk built into your portfolio. Now, conversely, if you're in your 20s or 30s, you can afford it to be a risk-on portfolio because you have plenty of time to make it up before you're going to be retiring. One other thing we can look at are non-market correlated or low market correlated securities, also known as alternative investments. Examples of these non-market or low market correlated securities include multi-sector bond ETFs, mergers and acquisitions ETFs, or hedge replication ETFs. All right, guys, that's all I have for you today. With everything that we've gone over, it is a great time to look over your portfolio, speak to your financial advisor. Guys, there are links in the description for all the gear that I use to film my videos in case you're looking to do something like this in the future. And as always, like and subscribe. Appreciate you watching, and I'll see you in the next video.